that slide was really the context slide for this, because often entrepreneurs say, well, geez, how come you guys got to make 40%? Or like, why do you need 5x or 10x? You know, that doesn't make any sense to me. I got a great company. I'm going to get there from cradle to grave. Why do you need to make that kind of money on me? Well, the reason we need to make that kind of money on you is that for every 16 products that go into the clinic, 2 come out at the back end, and of those 2, one's crappy. It's commercial, but it's of no value, or it's of low value, and one really wins. So our hit rate is 12%. And that's not our hit rate, that's the industry hit rate. That's the hit rate for everybody who tries to develop therapeutic products. And I can put up exactly the same chart for a med tech. Okay, it would look a little bit different in that a few more products would get to market, so more would actually get across the chasm, but not very many of them would become really big commercial products. So the chart would look exactly the same. So this is the issue. This is why guys like us are looking for these kinds of capital returns. And this virtually infinite number really means that the money that funds the preclinical stage has to come from people who have other motivations other than a return on capital. Governments, economic development, friends and family, foundations, charities, whatever it might be. But that's the challenge. I said it was tough to build companies. I want you to give you a little perspective on just how tough. So I didn't set the bar very high here. These are companies that either today are public companies with more than $100 million market cap, or that are public or private companies that have sold since the beginning of 2000 for more than 100 million. This is all companies, all categories, med tech, life sciences in Canada. There's only 26 companies on this chart. Now there might have been some public companies that came in and out, so they were over 100 million for a while, and they blew their brains out, and now they're not worth anything. So I'm talking about sustainable value. So for all the money you've heard about going into our space, 26 companies. And I might have missed 1 or 2, but not many. So let's talk about now a little bit further about the capital resources and what's different about Canada and other markets. So I don't want to belabor this chart, but what this chart says, if you look at Canada and you look at the US, and I assume there's a laser on this or something, but the first 2 columns are the US and Canada. And sorry, it's just this one? Oh, yeah. Okay, so this is the US, this is Canada. If you look at our percentage spending on R&D as countries, it's almost identical on a per capita basis. Fabulous, that sounds great. The problem is, see this part? This is real dollars invested. See this part? That's real dollars invested. See this part? It's tax incentives. So if you don't have any money, you can't get any money from the federal government. And that's the problem. We have an innovation system that's based on tax incentives. By the way, this number has just gone up. This number's gone up because Obama just committed $5 billion to NIH for each of the next 2 years. So this number's way worse now for us relative to the US. So what's happening on the public market? Well, it's pretty bad. If you look at funding for life sciences companies, I'm only talking life sciences companies because that's all I do. If you look at funding for life sciences companies, it was kind of cruising along, $1.4 million for 06, 07, all good. We hit 08, complete disaster. The number fell, I don't know, 300 million. It's come up a little bit in 09, but it's not going to be anywhere near what it was in those prior years. And in fact, most of the money that's gone into public companies has been very selective and typically into bigger companies. It's been a real bifurcated market. There's been lots of deals of $1 million. And then there's been a bunch of deals at $20 or $30 million. And there's been almost nothing in the middle. I mean, there's been a few, but it's been really, really lean. So what's happened across the broader sort of venture and angel market? And so the blue are angel, the blue are deals and for VCs, and the red are deals for, the other way. Red are angels, or red are VCs. And what you see is a big trend coming down. So in 2001, almost 700 million was invested in the space. This year, our forecast internally, about 150 million. So in an 8-year time span, you're going to have about a quarter as much capital available for investment. And a big part of the problem is that there simply has been no new capital formation, and I'll talk about that in a new slide. But this isn't anticipated to change anytime in the next year. So when you think about financing, recognize that this has been a downhill slope particularly for the last little while, and very, very sharply during the last 18 months. This is a slightly different perspective. So we went and did some internal analysis around where capital had gone and where it had been deployed in Canada in the time frame from 2004 to 2008. Because one of the things we were concerned about was understanding why, when you look at the data, it looked like we were putting as much money into early stage spending as the US was on what I would call on a per capita basis. I use the 10% rule. So we should have 10% of everything that the US has. And it looked like the spend on early stage was about the same. So if you look here, and you look here, it's actually 10.83%. So you go, wow, we're spending the same amount on early stage. Why aren't we having the same kind of successes at the back end? So we looked at that and we said, well, let's look at the late stage now. 28 billion, oh, interesting, less than $1 billion. So our problem is, well, the metric is widely known that for every dollar you put into early stage, you need somewhere between $3 and $4 for late stage. We haven't done that. And probably at the early stage, I don't have the data for this, but I'm just going to make it up anyway. I suspect that we took that early stage money and we spread it across way too many companies. So I think we got double whammied. We went way, way, way too broad, and then we had no follow-up money for that way, way too broad. And so this is a real challenge. And in fact, if you look, life sciences or med tech specific capital that's been raised since 2004 is about $275 million. That's new capital formation in this country. It's nothing. And of that, only 25% is late stage focused. I mean, totally dedicated to late stage. So this is a real issue. And let me talk about one last thing, and if there's any feds in the room, I really want you to think about this one. Excellent. Well, I'm really happy to hear that. So here is revenue growth for RX&D, the biggest pharma companies, all the pharma companies in this country, not the biggest pharma companies in this country, during the period from 1988 to 2002. And why is that period relevant? In 1988, the government passed a law giving pharma companies patent protection. And as part of that deal, they had an agreement, they had a handshake that said, we're going to spend at least 10% of our revenues on fundamental R&D. Wow, it's a perfect trade-off. That's kind of what other countries are doing. It sounds like a good way to get pharma spending their money. And so through this period, lo and behold, that's kind of what happened. And by 2002, those guys were spending about 9.9% of their revenues on R&D. You might argue that it really wasn't R&D. It was a lot of clinical stuff. Really wasn't basic innovation-based R&D, but at least they got to that number. And so what you see here, if you look at this graph, is they were behind, and then they actually overspent. So there were a couple of years right in here before 2001 when those guys actually spent at about the 11 or 12% level. Fantastic. Then a funny thing happened. 2001, revenues grew 52%. They went from 12 billion to 16 billion. But the commitment to R&D only went up by 24%, which means that, and what happened was the spend dropped from 10 to 8. So the deficit in spending was $1.1 billion. Think about that. 150 million going into venture-backed companies this year, and a deficit of $1.2 billion from RX&D. And I asked someone at the Federal Ministry of Research and Innovation the other day, and I'm not going to quote the person because I don't want to embarrass them, but I said, how can this be? And you know what she said to me? She said, we made a decision. We're going to trade innovation for cost saving. That's what she told me. Innovation for cost saving. And the real tragedy is we don't have the cheapest drugs in the world. In fact, our drugs are just right in the middle. Nothing special about this. So when you think about issues you want to bring up with your local MPs, bring this one up. Talk about how we're going to have an innovation economy in Canada if the guys who get the most out of the economy aren't spending on it.